amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
Even gave the stock market a temporary second win.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with a steward's view. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. I'm Aaron Kolkman. That's Chaz Louder, and this is A Steward's View. So glad you joined us again. Remember to visit this and previous episodes online at astewardsview.com or on your favorite podcast platform. Listen, like, follow, and share ASV. Let's take a look at what happened last week. U.S. equity indexes posted strong returns for the month of May, but gains in the shortened last week were held in check after more tariff uncertainty emerged. The S&P 500, NASDAQ Composite, and Russell 2000 indexes rose 2% or less for the week. 10 of 11 S&P 500 sectors were positive, led by real estate and healthcare. Energy was the lone decliner, pressured by sliding crude oil prices as OPEC Plus was said to be considering more production increases. Gold futures slipped 1%, while Bitcoin dropped 3%. U.S. Treasury yields eased as investors sorted through the latest barrage of tariff-related news. Then late on Wednesday, a U.S. trade court ruling blocked most of the tariffs initiated this year, not including sector-specific levies. However, the following day, a federal appeals court paused the lower court ruling to consider the government's request for review. Meanwhile, the White House accused China of violating the recently reached agreement on tariffs, and Treasury Secretary Bessent said that the trade talks between the countries were a bit stalled. The involvement of the courts, along with tensions between the two largest global economies, added new wrinkles to an already complex and seemingly fragile situation. Economic data was generally positive last week, with sentiment indicators improving. Consumer confidence jumped to 98 in May, a 12-point increase from the prior reading, while the Consumer Sentiment Index edged up to 52.2 from 50.8, and inflation expectations eased slightly. The second estimate of Q1 GDP for this year showed a slightly smaller contraction at negative 0.2%, while the U.S. goods trade deficit narrowed sharply in April as the boost from tariff front-running faded. Minutes from the last Federal Open Market Committee meeting revealed difficult trade-offs faced by the committee if inflation and unemployment start to rise in tandem. Finally, chip giant NVIDIA jumped more than 9% before pulling back after positive first quarter results that exceeded expectations despite challenges related to China export rules. Artificial intelligence continues to attract substantial investment, which should be seen as a tailwind to growth sectors of the markets. Overseas, Japan considered trimming issuance of super long bonds in response to the recent rise in yields. A weak auction on Wednesday raised concerns of dwindling demand from bond investors in the heavily indebted country. Expectations for a Bank of Japan rate hike in July ramped up after two key core inflation readings accelerated. In Europe, Germany's CPI held steady at 2.1% year over year in May, while consumer sentiment rose for a third straight month. European Central Bank President Lagarde said that erratic U.S. economic policies could present an opportunity for the euro to take on a larger global role, but not without improvements in capital market structure and legal foundations. Now let's get going. This week on A Steward's View, it's going to be more about total return investing in both segments. Last week, we talked about diversifying your holdings and return types. We talked about return types being capital appreciation, capital gains, dividends, and interest. So let's review quickly. Capital appreciation or depreciation comes from the movement of any holding, any security, any invested asset, and does not create a taxable event. It just represents a rise or a fall in the price of an asset. So an asset moves up or down. There's really not a transaction that occurs. and therefore there's no tax associated. Capital gains are different. They are created by selling an asset at a gain. It could be a loss, but the idea here is we want to make something. And so we are selling at a gain by owning something over 1 year. We may own that asset directly. We may own it through a fund. If we own it through a fund, an exchange-traded fund or a mutual fund, let's say, those funds may distribute capital gains that the fund itself created and is now passing along to investors. Those transactions, those capital gains transactions, are taxed at short-term or long-term capital gains rates. The most favorable of the two is long-term gains rates, and that just is when the asset is held over 1 year, and there's a transaction or a gain generated called a recognized or realized gain, depending on who you're talking to. And those rates, by the way, are 0%, 15%, or 20%, depending on your tax bracket. So just to review, a long-term capital gain is an asset sold where we recognize or realize a gain after holding that asset over 1 year. And the tax rate on that gain, that transaction, is either 0, 15, or 20%. And again, that depends on your tax bracket. Meanwhile, short-term capital gains are taxed at your ordinary income levels, just the same as if you went out and earned the income. Okay, so whatever that bracket and effective income rate is that you are in, that would be the rate that applies to your short-term capital gain or assets sold that are held under 1 year, right? Or let's say a year or less. Okay, try not to hold an asset for 1 year. Just wait a day, and then you can get the long-term gains rate. Chaz is raising his hand. Chaz, go for it.
Professor Aaron, could you give an example of a short-term capital gains? Because I would think a long-term is like when I sold my house, I owned free and clear. I got to enjoy those capital gains. How about a short-term? Could you give an example of that?
Sure. Yeah, I mean, we talk a lot about trading and investing and the differences between the two. When you're trading regularly, hopefully you're generating a gain. But if you do, you're creating a gain that on an asset held under 1 year. So I go by, we talked about NVIDIA in the market readout here a little bit ago. I bought NVIDIA. The stock price went up and I sold it the next month.
Gotcha.
Okay, well, I only held it for a month. So that's akin to having earned that income some other way, right? However, if I held it over a year, then I would have this favorable tax rate that applies.
Oh, okay. Good.
So that's, I wouldn't say that something held 366 days is really a long-term investment, but from a tax standpoint, I'm glad you asked, Chaz. From a tax standpoint, you would have a long-term capital gain, right? If you had held that same asset, NVIDIA in this case, 366 days or more.
Thanks, brother. That's helpful.
Hey, whatever I can do. So then we've talked about capital appreciation. We've talked about capital gains. It could be capital losses, by the way, and we'll come back to that a little bit in the second segment, I hope. There's another couple of return types that we've referenced without really talking about tax treatment of any of these return types, actually. But the next two that we've mentioned in past weeks is dividends and interest. So dividends are generated by holding a stock when the dividend is sent out. Okay, so a dividend is considered qualified. So think about capital gains. We had long-term and short-term. With dividends, we have qualified and non-qualified, right? So a qualified dividend is what we have if a shareholder has held a stock for more. This is tricky. Here we go. You've held the stock more than 60 days in the 121-day period that began 60 days before the ex-dividend date. Oh, boy. Right? Does that sound like a group of,
sounds like
maybe attorneys or accountants that got together and drafted something, Hopefully it wasn't Friday night. But let's use an example. Okay, so I have a qualifying dividend. Let's pretend for a moment that NVIDIA pays a dividend. Okay, I don't know off the top of my head if they do or don't. But if they did, and I doubt that they do, and I had bought the stock for 60 days prior, okay, to the ex-dividend date. Now, the ex-dividend date, let's be clear here. I want to get this right. is one market day before the dividend's record date. Okay, so the dividend's record date is whoever owns that stock when the dividend is recorded, right? The record date, that's who gets the dividend. All right. So one market day before that is the ex-dividend date, right? In other words, I could trade the stock off and not get the dividend. Okay. 60 days before that, if I had bought the stock or more, right? And I held the stock for a total somewhere of 121 days, right? Before or after the dividend actually occurred, then I have a qualifying dividend. So the IRS is really trying to identify who's the long-term investor versus who's trading, right? Okay, in 121 days is, again, not a long-term time frame, but it's also not a day trading situation or speculation, as Paul Larson calls it. All right. So qualifying dividends are, frankly, pretty easy to get compared to long-term capital gains, right? I've got a 121-day holding period, as long as I meet a couple of rules. And then I'm going to get that same favorable tax treatment, 0, 15, or 20% on that dividend, right? As opposed to what? A non-qualifying dividend that didn't meet those criteria. And then I've just got another ordinary income item, right? And so I went out and earned this income in the marketplace somehow, okay? So capital gains and dividends are similar in that you may or may not get favorable tax treatment, but at least it's a possibility, right? Interest is a different animal. Interest comes from fixed income investments like CDs or bonds, as we talk about a lot in this program. Those interest items are taxed at ordinary income tax rates no matter what. All right. We're not looking for exceptions to the rule in these conversations. By the way, we're just going at an 8,000 foot view to talk about, in this case, the different kinds of tax treatment on the different return types that are available. So bond interest, ordinary income, dividends, qualifying or non-qualifying, favorable or not favorable, depends. Capital gains could be favorable if they're long-term, could be ordinary if they're short-term, right? Ordinary is earned income. Capital appreciation, Chaz, quiz, is taxed or not taxed?
Oh, man, don't do this to me.
This is the first thing we said. I thought you were over there taking notes. What's going on here?
I am taking notes. I mean, I've been thinking about what you said. I'm going to say that it's I'm going to say it's taxed.
Not taxed.
Not taxed.
Oh, I knew that was your next guess. You had a 50% chance of being right.
Brother,
so, okay.
I am thoroughly enjoying it. I just want to give that this one thing. You said this already, but because this is an 8,000 foot look as well, I want to make sure our listeners know this is some of these definitions you will read about in The Life Cycle of Wealth by Aaron Kolkman that's available.
I don't know if I covered all this, Jazz. I hope I did. It's been 10 years since I wrote that book.
So maybe you definitely covered some of this in that, because it didn't sound completely foreign to me. So,
well, we're about to republish. I know some of these concepts are there. I think tax treatment got left off, so we stayed conceptual. But
no, that's what I'm saying.
There's a reason to talk about all this, though. Yeah. Can I just tell you what that reason is? And we'll come right to it and then get into the second segment and go from there. But one thing I do talk about in the book actually is what a wealth management office actually is. Okay, and a wealth management office, in the purest sense, is a strategy office. It's one that does. Now, they may or may not do brokerage work. They may or may not. Well, they're definitely doing advisory work, right? That just means that they're delivering advice for a fee of some kind. But the distinction between, I have, this group of advisors over here. And let's pretend for a minute that there is, in fact, a clear difference between brokers and advisors. There often, is not a difference or a clear difference. Operationally, there's a huge difference, but the vernacular sounds the same, okay, in many conversations. So we go from brokerage to advice to wealth management. And what we're doing when we go to wealth management, we're talking about strategy, okay? So my argument here is that a seasoned advisor or advisors can deliver strategy, and that's what, genuinely speaking, a wealth management office is. Okay, that's what Fiduciary Advisors is, right? Just to confuse things a little bit more, the name advisors instead of Fiduciary Wealth Management, but we are a wealth management office. Okay, so in wealth management, when we're building a strategy and we're talking about taxes today, a multi-year tax plan and management program. That is what, in the truest sense, what needs to happen, particularly for families with complexity and typically with higher net worth. Okay. My firm serves a net worth range between 1 and 10 million. It can go up to 20, but it's typically 1 to 10. And the investable asset base, it tends to be between 1 and 5 million. Okay. So when you're in that zone as an investor, which is who this program is designed to support and encourage, I'll say it again, the multi-year tax plan and tax management or management program is mission critical. Okay. And it includes things that we'll talk about in the second segment and maybe in future weeks. It includes the matching of gains and losses. It includes tax loss harvesting. And it includes tax location. Okay. So we'll pause there. And when we come back, let's touch on those. And then remember, we're still talking about total return investing, and we'll redefine that when we come back too.
More of A Steward's View in just a moment. Investors have stocks, bonds, mutual funds, ETFs, options, futures, real estate, and more. There's one place to look at all of your portfolio. It's called Fusion, Portfolio Aggregation. No contract, no hassles. Fidere's portfolio technology gives its users a chance to see all of their assets all the time, wherever they are. The Fusion platform is open for use without a contract and without a hitch. It's based on mean variance optimization and analysis research by Aaron Kolkman. Fidere uses the Fusion platform to optimize assets for its clients. For more information, visit fidereadvice.com and click on Fusion at the top of the page. That's Fidere Advice, FIDERE advice.com. Now back to A Steward's View with your host, Aaron Kolkman.
And we're back. Let's quickly revisit total return investing. The past few weeks, we've talked about this. Total return investing means the reinvestment of all return sources year over year, right? Whether or not we're taking income out, but especially if we are, we're diversifying, hopefully diversifying our return sources in addition to our asset types, which are generating those return types that we've just talked about in regards to tax treatment, and we're reinvesting those year over year. Okay, that's what total return investing is, right? And in a recent session, I was really cautionary about dividend investing, and that's one that I'll just refer to about 2 weeks ago. But total return investing is let's just call it a method of getting to consistency investing, which is the entirety of what I spend my weeks doing as it relates to investing, not planning per se, but investing in support of plans. Okay. So when we take that context and we look at what the tax plan is with an investment plan, so we're tying investing and taxes together in this session, and we zoom out and we go, okay, I have a full balance sheet here, and I have a cash flow statement for any given family or household. And I want to look at this year over year and figure out where are my opportunities, and what's the goal, by the way. What does an opportunity look like? The goal as it relates to tax planning, dotted line to investing, is to dial down or minimize tax liability. Okay. If somebody says, well, we can zero out your liability or give you no liability, no tax due, please run in the other direction. Okay. What you can do is you can minimize it. Okay. Or you can plan it year over year. So Chaz, you use the example of your house, and you said, well, I sorry, I forgot exactly what you said, but I think you said you sold one and bought one. Is that true?
I owned a house free and clear, and I was using it as a rental. And then the market was exploding, and I'm like, hey, seller's market, I'm going to sell it. And then I got to enjoy Uncle Sam giving me the privilege of paying them some capital gains. So,
yeah, so you got an exemption on that gain. You still got a 1099, didn't you? But you didn't actually have to pay a tax on that gain, did you?
Yeah, see, that's a question for the CFO. But no,
sure.
we paid capital gains on that because we did. I don't know what rate it was at, but we did.
Okay. Well, wait. You should get a 1099 stating that there was a gain in that transaction, right? When you sold the other property. If you lived in it 2 years out of the last 5,
I did.
Then you would have a gain exemption. Okay. And for a married couple in your case, that exemption amount is $500,000, $500,000.
Okay. So time out.
Okay.
I didn't live in that house it was over that. I lived in that house for 12 years and then I rented it for like 5. So there you go.
Oh, wow. That's tricky. So if you rented it for the 5 years prior to selling it, then you would in fact have a tax due.
Yeah, I did.
On that gain. However, I am not formally a tax advisor and this is not formal tax advice.
I remember this conversation because I was with my tax preparer and we were with whatever, they're trying to figure out, like you're talking about here, dealing with the tax liability at its lowest point. And they were trying to figure out how to massage it, not do anything shady, but we were within like a few months of having to pay. Like we had to pony up.
In respectfully, I'm sorry. First, I want to say I'm sorry you had to, you had to carry pay any tax at all on what was once your primary residence.
Yep.
Okay. Second of all, this turned into an excellent example of what I'm talking about. And that is to say, if we know that there are life events coming that have tax consequences, and we can look out, and, I do this with current families here at my firm about once a year. I mean, we try to touch everybody that wants that, and we update the tax plan. And the tax plan may just be 1 year, it may be 3 or 5. Mm-hmm. Okay, past that, it's a little bit hard when you're dealing with income taxes and all the changes to the tax code and then life circumstances. Okay,
Aaron, to speak to your thing, man, is like if my tax preparer, and I'm not putting in my tax preparer under it. He was my guy for several years. If he would have said, "Hey, you've got this house, and just FYI, you're getting ready to be within a year here. If you guys are going to hold on to this house or you're going to sell it," he could have helped me make a better decision. Maybe that's not his purview. Maybe that's a person like yourself. But there you go.
Right. When you get to prep and filing, thank you for that comment. When you get to prep and filing, I mean, you whatever deal is going to happen is already done, right? Mm-hmm. And now you're just looking at it in hindsight. And so that's exactly the point of planning, isn't it? And so what I would call, real or comprehensive financial planning, and this is the kind I write about in the life cycle book. All right. We don't talk about tax planning in this detailed fashion. I'm sorry. I really don't think it's there. But the comment is that the multi-year tax plan would have caught that intent at least, right? Could we have pegged the transaction? Did you know who you're going to sell it to, in advance, and for how much? Probably not. But could you have said, well, we're going to sell this house. My wife and I are going to sell this house in X amount of time, we think, and, have some idea of what you might sell it for compared to what you bought it at? Sure. Yeah, you could do that. So if that's going on, that's a classic example. There are lots of complex rules, by the way, about investment real estate that we're not talking about. So a simpler example is the one we have with your house sale. But if that's going on, that we can plan that and you get the exemption, or in your case, you didn't get the exemption. Let's say that was a second property. And this is actually a great example all by itself. It's an investment property that you own and you're going to sell it and you're going to generate a capital gain on it. Okay. Well, if we don't have any depreciation recapture, right, then what we can get is a projection of how that particular year, let's say it's 2 years from now, right? You and your spouse are going to retire in 2 years from your day jobs. Okay. And you're going to unwind a bunch of different assets and create liquidity or bring it into your portfolio. That gain, as you just described, in what could have been your primary residence, home sale or homestead sale, is now an investment property, right? And so you have to pay the liability. Well, let me ask you a question. What if you said, well, I've got this portfolio over here that's a taxable portfolio, and I can generate some paper losses to offset those gains in that particular tax year. So let's pretend for a moment that the year is 2010 when that happened, or even 2019. And you said, well, I'm going to sell this investment property in 2 years. Well, if it's going to be sold at a gain and we have some embedded losses in the portfolio, what year do you suppose, I'll ask you this way, if I can use losses against gain, and I can, right? If I have some long-term losses in my taxable portfolio that are already there, what year do you suppose I'd want to go ahead and recognize those losses? Maybe the same year that I'm going to recognize the gain? Sure. Why? Because if I have a $100,000 gain, as an example, in that investment property, and I have a $50,000 loss in my portfolio, and it's a taxable account, I can match those two as long as they're both long-term items. Okay? Now what? Now I only have a net $50,000 gain that I'm liable for. Okay? So that is multi-year tax planning in basic form, right? I mean, it gets far more detailed than that, but there's so much that can be done when it comes to matching gains and losses. And that's one of the three concepts that I wanted to touch on. The other two are tax loss harvesting, which was the embedded loss piece of that puzzle I just painted. And then the third piece is tax location. And I think we should probably talk about tax location for investors in a future episode based on where we're at in this particular one. But I'll just mention that where I hold the different, we talked about the different return types, where I hold the different asset types that are generating those returns, what account types I hold them in is also very important. Why? Because if let's say I have a bond portfolio and I could choose to hold it in my taxable account, or I could hold it in my IRA, or even my Roth IRA. Well, of the return types we talked about and the tax treatment associated, it's the most expensive type of return generating this ordinary income interest. Okay, I can't get a better deal, so to speak, with the tax man. So I'm going to hold that particular set of assets in my IRA or Roth IRA, right? Meanwhile, I'm going to take my growth assets, my appreciating assets, could be depreciating, but 4 years out of 5, it's appreciating. It's stocks, okay? And I'm talking about major companies. Now we have appreciation. We have hopefully qualifying dividends, hopefully long-term capital gains held in my taxable account or accounts, okay? And you see where I'm trying to take the tax-benefited return types and put them in the taxable account, and I'm trying to take the less beneficial return types and put them in the IRA, right? I have the same portfolio with the same holdings, managed with the same investment plan, but now I'm going to enhance my return. How? By reducing my liability, right? And that's called tax location. So there are other phrases to describe that, like tax optimization, I think is one. Asset location is one. But in short form, that's tax location. So there's a lot that can happen in a full service firm that's doing comprehensive planning. There's a lot that can happen just with tax planning year over year or multi-year tax planning and management. So, one thing I like to do is to say, okay, like I'm a retained planner before I invest $1. Retained planning has a hard cost. So I'll go on record with a family and say, if we're not covering our retainer, we'll refund that retainer to you, right? And this, what I'm talking about right here in this session, is one of the ways that we often cover that retainer, right? So just doing comprehensive work typically enhances wealth all by itself. And there are a lot of good firms in town that do that, in the country that do that. I just want to make sure I articulate to our listeners how critically important it is for various types of tax planning and management to occur on a routine basis inside of a financial plan, as opposed to, we're going to retire in X amount of time from our day jobs, so we're just going to save everything we can and kind of set it and forget it. And then what we'll do is, we'll have a tax change as to our income tax brackets at that point in the future when we actually make these changes, and then we'll think about it. No. Life is far more fluid than that. So we just got to keep up with this stuff. There's a lot of good that can come out of multi-year tax planning. So in future weeks, we'll also invite other professionals that have tax expertise to offer onto the program. And I will not name names just yet because we haven't confirmed, but at least we could touch on some of these topics. So before we close, let's look at what's coming up with the week ahead here. And I want to do that in short form. As the calendar turns to June, the focus shifts to the monthly U.S. jobs data along with central bank decisions in Canada and Europe. Jobless claims ticked up to 240,000 last week, and other U.S. employment indicators have been trending lower. So investors will be watching not only Friday's non-farm payroll results, but for May, but also any potential revisions for prior months. ISM manufacturing and services PMIs will be released today and Wednesday, respectively. Fed Chair Powell is scheduled to speak at a conference in Washington today. The rest of the U.S. economic calendar includes factory orders, revised productivity figures, and a consumer credit update. Meanwhile, the European Central Bank is expected to cut rates by 25 basis points or 0.25% at Thursday's meeting, with another reduction not being priced in until October. The euro has benefited from the declining U.S. dollar and may stay elevated if the ECB signals that its rate-cutting cycle is nearing an end. And consumer inflation for the Eurozone arrives on Tuesday. Meanwhile, the Bank of Canada is likely to hold rates at 2.75%, with traders awaiting any forward guidance. And last but not least, OPEC Plus was planning to meet this past Saturday to discuss a production increase in July that could mirror or exceed the 411,000 barrel a day hike in April. And with that, it's been such a pleasure to be back with you. I do hope this session has been a benefit to you and others you decide to share it with. We invite you to interact with us on your favorite podcast platform or at astewardsview.com. You can also schedule with our sponsor, Fidere Advisors, in the footer of that website. That's astewardsview.com. From all of us at A Steward's View, we look forward to connecting with you again next week. Until then, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidere Advisors or speak with Aaron, visit fidereadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidere Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidere maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidere and its representatives do not offer tax or legal advice through Fidere. Please consult the appropriate advisor. Fidere Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidere, please visit fidereadvice.com. That's FIDERE advice.com.